Ladies and gentlemen of the crypto space, we're live on a Thursday, December 7th at 12:17 p.m. Now, as the title suggests, something very clear. It's everything is not so clear. So, what do I mean by boomer rug? It's not what people think. I don't think that they lose their wealth in the way people would jump to conclusions like, oh, the stock market just collapses. Like the whole point of everything they're doing in the financial economy is to make sure there's a capacity to finance the retirement population, to find or keep elevated the valuations of 401ks for retirement purposes, and to basically maintain the function, the integrity of the financial economy, because that services a significant need of the real economy, of the general public, and this all plays into politicians serving their constituents, and that is generally what I expect to occur. I expect to occur support in the economy, but I think things are changing. Um, I think flows are going to be very different. We're going to see different behavior in markets, but that's generally the case for every cycle, every period of change in financial markets. They appear the same, they appear similar. History doesn't repeat, it rhymes, stuff like that. So that's what we're seeing. We're seeing appreciation in crypto markets. We're seeing relative support in equity markets. We're not seeing total collapse in equity markets, and that's because the financial economy has been papered over. Now, really, the story for what's going on right now from a macro financial standpoint, wrong screen, wrong screen again, is Japan. Japan has been putting support on their currency vis-a-vis talk of interest rate raises. That obviously depreciated their bonds, but that has appreciated the yen, and that has put pressure on the dollar down or relieved buying pressure on the dollar. Now, how long this can continue, or can they really um, can they hold this directionality for how long is probably a good question to ask. So that's generally my sentiment as well. My expectation is they're trying to get a cycle. And we talk about cycles in the crypto market, and we see this periodic cycle over 4 years that we've defined as the halving. Uh, but this has become macroeconomic, and and the cycle is a manifestation of flows, cross currency flows, cross geographic flows, flows of capital from country to country. And they really need capital flows into Japan. They need to stabilize the dollar. They need to stabilize the capacity for the world to have access to energy. So the interest rate raises in the United States is really an interest rate raise around the world, and foreign countries have an effect on their respective liquidity environment because of their individual interest rate policy. But generally speaking, energy is all denominated in dollars, and the world has been trying to push against that reality, and that has been the case for a long time now, and that will check back in 10 years, check back in 20 years. But the point being, the dollar comes down. If they're able to create a cycle where foreign currency appreciates, the dollar comes down, then pressure comes off, or pressure, yeah, comes off the resistance to the world being in a position to inflate the private credit markets. And that creates the liquidity flush scenario where you have a degree of malinvestment, but you also have a degree of rational investment and allocation to enterprise that has the capacity to actually be viable in what I argue is a changing world construct. What it means to be a viable enterprise is being quickly redefined, and we're seeing that in conditions not necessarily NASDAQ, but if you look at like the Russell 2000, it has gone almost nowhere for it's up 6% since 2018. So this is 2000. You could look at even a larger index, but this is an easy way to inspect the state of of the broad equities markets. And dare we make this inflation adjusted? Dare we make it money supply adjusted? And the equities markets is a shit investment. Broad equities markets. The S&P, if anything, uh, is reflecting what folks have said, where it will be more in line with the growth of overall liquidity on the planet, because the U.S. stock market and the S&P is not just the U.S. market, it's an investment destination for the entire planet. And that's what's occurring. S&P, as Raul talks about, correlates pretty much one-to-one with the growth of global liquidity, the strength of global liquidity conditions, and NASDAQ outperforms, and that's as we see. 6.64% of the day, 1.47% of the day for NASDAQ, and it's behaving very well, as Raul has discussed, and because that introduces or adds to confluence, suggesting his observations are quite reasonable. All things said, everything that we're observing that is consistent with what Raul talks about, is consistent with what I talk about, where I expect a big restructuring of equity markets, where what is a viable enterprise is being redefined with a higher interest rate environment. Zombie companies are going to get flushed down the toilet. We get a bottom at 2.5% on rates. There's going to be a lot of companies that can't refinance, and that's exactly what we're seeing in the bankruptcy filings. We have the largest bankruptcy filings right now, the conditions in the United States, for over a decade. Was it 2012, 2014, somewhere in there? So it's large, and that will continue. That is the trend. That is the directionality, and directionality continues until capitulation, and capitulation will be the exhaustion of companies that are no longer viable in a relatively higher interest rate environment. And all of this implies what has occurred, generally after 2000, the 2008 episode, with a zero interest rate policy, that malinvestment will be cured to a degree, and more due diligence and more time investment is warranted in assessing what is a viable enterprise. No longer a zombie company that's not a viable enterprise. They can't refinance their shit. And that is very consistent with the way I inspect these crypto enterprises, these purely financial enterprises that have a pristine balance sheet. Zero debt, zero human resources, zero real estate, zero OPEX requirements. It's just pure cash flow. These are literally like pristine enterprise. I mean, folks talk about pristine collateral, and U.S. duration is still pristine collateral with regard to how it creates the global liquidity, how it prints global liquidity. Sure, great. But in an Ethereum-centric emerging market, Ethereum is pristine collateral, and I like the terminology pristine enterprise. I think that we could coin a new terminology today, ladies and gentlemen. Pristine enterprise, because that is probably the best way to express what literally we've been discussing for the last 2+ years. That's why these things survived. The only reason countless equities survived in a zero interest rate environment is because they were literally able to refinance their debt, and that allowed their balance sheet to remain operationally in the green. And now they're not in the green, so they're not going to survive. And what have we talked about the last 2+ years? What survives will tell us what is viable. And what is viable in an immutable and deterministic world will be exposed to market conditions in the future, and market conditions in the future will be a significantly increased global liquidity environment, because the sovereigns need to get the cycle to cycle if they want to continue this global rules-based order regime that they've been they've been deploying and maintaining and executing for the last couple of decades. And man, oh man, uh, I dare we talk about just how remarkable these enterprises are in a world of tighter credit conditions or increased rates and counterparty risk, and what they do, what these enterprises do with regard to their capacity to create dollar liabilities permissionlessly. That's pristine enterprise. It's the biggest business on the planet. I don't care about commodities. I mean, I have allocations to commodities, but that's not the thing that excites me. The thing that excites me from an enterprise standpoint is shit that we traditionally had zero access to in the past. We had no access to own banking cash flows. Equities are nothing of an expression of a bank's cash flow. The dividend is either diluted to point where it's useless, or you basically have no exposure to the cash flow of a bank, and then you have the entire construct of a traditional enterprise and all the OPEX, all the associated OPEX. In this instance, the enterprise that we look at is that banking infrastructure, and that cash flow is literally just passed through to us. That's crazy. Pristine enterprise. That's the phrase of today, of the day, of the year. It's remarkable. Markets are on fire. Favorable conditions, bids everywhere. Ethereum pushing past $2,300. Nice to see. Trend lines vanish. Levels are clearly it's broken out. I mean, the level to break out from was 2142, and we're at 2341. Everything's at a premium, so that's something we've discussed: buying at a premium or being able to purchase at a discount. Bitcoin has no bid today. It has support. Pretty much flat on the day. Ethereum significantly outperforming Bitcoin today. Looks like this 50 SMA on the monthly is expressing support. People are finding Ethereum at a cheap enough price relative to Bitcoin, and that is what the data is expressing. These charts are not just price, they're an expression of the perception of value by the average market actor. This is the consensus value that all actors combined say it's worth. What is that? Efficient market theory type stuff, and this is price action, pricing, spot price is consensus. So that's interesting. So the story of every chart is meaningful, and then the cross, the pairing, the spread between asset prices, dollar denominated, is meaningful. Dollars are meaningful. It's not going anywhere, and it's painful to say, but it's not. Is it painful to say? I mean, you got to understand how to traverse the system. You don't bet on the end of the world, and we have to navigate the shit that is presented to us, and that's the shit that's presented to us. So that's why we tell the story the way we do. Look at Frax, over $9. That's good to see. Up well over 100% since bottom. Not well, but up over 100% since bottom. Curve up at 65 cents. That's good to see. Everything's moving. I like to keep an eye on DOT. I have an old legacy position, but it has clearly broken out from the monthly time-weighted average price. That's good to see. Solana continues its move up. Everything about this price screams at a premium. On the weekly, it's above all moving averages. On the monthly, it's way in a premium. You're not buying at a discount if you're buying at these levels. Let's go out to a 6-month for the fun of it. Nope, useless. Useless data. 3-month, you could argue this is the average price. So maybe, you're still not buying at a discount, even on the 3-month 10 SMA. You're starting to buy at a premium. So there's great reason to argue Solana's just getting started. Very volatile, arguably volatile as early Ethereum days. So the type of price action you could expect is ridiculous. This thing goes to like 1,000 and retraces to, the 10 SMA gets to 100, 140, 180 by 2025, and it literally retraces from 1,000 to 180. That's the significance of moving averages. When the liquidity environment retreats, or the favorable liquidity environment retreats, it's going to regress to the average price. So that's why it's so significant to get at a discount, and that's why it's so significant to be involved in markets when they are not experiencing favorable liquidity conditions. Because by the time you're experiencing favorable liquidity conditions, the discounts are gone and you're buying at a premium. Maybe it's a marginal premium. Maybe it's just a little bit of a premium. And arguably, even at this price, Solana's at just a little bit of a premium relative to the average price. And you get a 10, 12x on the money, but you're not getting 100x. Folks that bought at $8, they're getting 100x, and they're going to capitalize significantly when prices go up much more, which it looks like that is the case. Cosmos has breached $10 a couple of times. It still is far from favorable conditions. Frankly, DOT is in increasingly favorable technical conditions. Structurally, Curve as well is not at a premium yet, at least from a monthly perspective. Shorter time frame, weekly, is nicely above the time-weighted average price, but this is probably meeting my expectations with regard to price action. There's constant sell pressure, which is the way the asset is designed. This is not expected to go to $100. You have crazy price action if you get back to all-time high, and that is probably where my expectation is. All right, you get back to all-time high and it retraces to $3, and it ends 2030 at $10. And I'd be like, okay, that is literally meeting my expectations. It's not like you're getting 100x on Solana price action. It's a different type of asset. Therefore, expectations need to align with those realities. Joe's in the house. Kazan's in the house. Raul. Dan, Thursday. Yeah, I'm off tomorrow. I'm taking a day, so I figured I'd get you guys some content. Tap. See, back-to-back streams. Yo, yeah. Are the boomers being rugged? Are the boomers rugging us? Yeah, it's hyperbole. Rugging. It's all about capital flows and capital flows from lack of opportunity to opportunity. So if the Russell 2000 continues to look like shit over the next 2 years, you could expect marginal capital flows. And the thing is, the kicker is, with crypto markets, marginal capital flows are going to produce ridiculous outperformance and ridiculous deviation from the mean for what it's worth. So if you go over to like a total 3, market's barely broken out. On the weekly, you're just pushing above the 100 SMA. There, you think you haven't seen anything with regard to microcaps. I mean, what's a microcap? 100 mil? And I'm talking about like traditional definitions for what a microcap, a mid-cap, and a large cap enterprise is. And I posted stuff like that on Twitter before. Now, it's all microcap and barely mid-cap, and there's literally top 10 are like large cap, 50 bill. So when you have $100 billion flow in, $100 billion of liquidity flow into this emerging market, that the multiples, the repricing that occurs for these assets is extraordinary. 10, 100x on the money. And then the liquidity becomes unfavorable, and it should be interesting conditions over the next couple of years. We could see increasing stickiness in these markets, in an elevated interest rate environment, and people anticipating future cycles and capital inflow. We could see increasing stickiness as compared to 2022. So obviously 2022 the fact that there was stickiness tells us everything, that it is a different market as compared to anything we could compare to historically. So in 2025, you get up to $2 trillion, $3 trillion in liquidity in DeFi markets, and then it retraces to a trillion. And $1 trillion gets stuck, gets sticky. That changes everything. And this is why time horizon is extraordinary. You got to look way past 2025. Look into 2030. 2030, and that's how you prepare for the future. And all you have to do is own assets that are cash flow positive, that are deterministic, and immutable. And they will exist in 2030. And that's how you're buying something today that will have something, a productive aspect to it in 7 years from now. And that makes the equation pretty simple, and that's really why I talk about the locking so much. It guarantees you're going to be exposed to the market in 2030. It's crazy to think about. If I were the government, I would rug down. Yeah, that's what Jamie Dimon said in his congressional testimony. They would shut it down. I mean, just look at the defensiveness of Bitcoin maximalists. You could expect the defensiveness of traditional finance and banking, the banking sector, to be just as ferocious, except they have a lot of levers to pull. They have a lot of pressures to place. And once again, that's why determinism and immutability are significant, because there's going to be a lot of volatility in the they fight you stage. And yeah, how do you get through that? You're not going to be able to emotionally handle it, but if you're forced to, if you are deterministically forced to traverse those periods of volatility and global macro liquidity fluctuations, then that's just a lovely thing. I mean, there's nothing like that in traditional finance, where you have the capacity to vacate uh, the potential to liquidate a position. It's not even like you're forced to hold the position, and that's why I talk about it in terms of a purchase. You purchase something, but you can't even sell it. It's pretty wild if you think about it in traditional financial terms. Sir Joe, President, accounted for. Check Kindercrack. I hope I got that right. Hey, people, welcome, welcome. Trevor, my man. Heart 9, Gonzola. I got it, I think. Joe, what if Sol replaces Eth? Replace doesn't work. That's not a realistic expectation. Everything has their place, their use case. And I have stereotyped the industry and these emerging markets, and I've talked about it for a long time. There's the China narrative, the India narrative, Solana is the enterprise narrative, and Ethereum has overtones of what Bitcoin did, because Bitcoin has this entrenchment, this historical presence. Ethereum, first mover advantage with regard to EVM networks. It has the Lindy effect, which is people feel comfortable with significant capital. That is meaningful, and that is everything. And I talk about Ethereum very differently than the average market actor that is afraid of gas prices, and obviously that must be considerable in terms of portfolio capacity. But this is where the money is going to be, because this is where the money is going to be most comfortable. Now, obviously, that changes over time as lindiness of Arbitrum optimism increase, and Avalanche and Phantom, and come on, how many goddamn chains are out there? I mean, literally, Celestia is freaking hot, but geez, it's literally like EVM chains are the new ICOs of 2016 and 2017. Now, sure, there's going to be, it's different than an ICO in that that was pure vaporware, just like meme coins are. It's just vapor, pure sentiment and perceived value, which is something I don't subscribe to nor really entertain. But the interesting thing that's different from the ICO era is that as we have this onslaught of EVM chains, um, some are going to stick. So they're meaningful in that regard, or at least meaningfully distinct from the ICO era in that regard, but they are comparable to the ICO era in that it's just an onslaught of EVM chains and just chains in general that do different things. And I'm like, no, I don't care. It's noise to me. It's literally noise. I don't have time. I don't have the capital. I certainly don't want to be diversified to that extent. And frankly, it's irrelevant because I want the lindiness. I want the comfortability. I want mainnet. And I don't. Yes, you could extend that on the risk curve, and you could catch significant price action and the flows and the exuberance and so on and so forth. And sure, but anything that deviates from the mean will at some point regress to the mean. So when you deviate significantly to the upside, it's going to be a big collapse. And that's a nice reductionist perspective of something that we've discussed and clarified over the years is what goes up comes down just as quick, but it's more than that. It's all about the average price. And you have a deviation to the upside and a deviation to the downside. Deviation to the downside, if something is lindy and growing and entrenched and moated, is a discount. If it's deviated to the upside, it's a premium. Don't buy premiums. So, which means you really needed to be exactly where we were in this community over the last 2+ years in it, watching for significant depreciation and building these narratives. If you bought, into Ethereum any time over the last year, okay. So now heading into this coming what it looks to be coming global liquidity cycle, we're in position to see how far are we deviated from the mean to the upside. How overextended are we? How does the financial conditions index look? How does domestic U.S. proxy liquidity look? Fed balance sheet type things. How does global M2 look to a degree? How do these pieces of data that give us likely confluence of a top? How does MOVE look? How does global collateral look? How does the bond market look? MOVE really is a great forward-looking indicator. It's a little early, but it's a forward-looking indicator of significantly decreasing liquidity conditions. And sure, if Bitcoin goes to $200,000 and you sell at $150,000, but you see the rolling over of it. That's exactly the conditions I'm looking for now, and I certainly wasn't prepared to do this in years past, but I am now. I don't want the top. The top doesn't make any sense in my mind, the way my framework works, the way my risk tolerance works, or even just the way I want to interact with these markets. Works. I want to sell way before the top, and I want to use this macroeconomic data that I understand to a great extent now, and I want to capitalize a certain quantity. That quantity is an expectation based on real-world needs. The most important thing new entrants to crypto markets can do is get rid of that expectation of more. I just want to make a lot of money. You need to set specifics. You need to define rules of engagement. You need to define expectations. Standard operating procedure. Stick to the rules. And not only will you thrive in a favorable liquidity market, you will identify much more effectively when that favorable liquidity market is evaporating, and you'll be able to prepare for shit conditions. And then, because we were able to capitalize, you'll have capital to take advantage of the shit liquidity conditions that produce the discounts that we've so nicely seen in the earlier parts of 2023 and obviously the later parts of 2022. Hope that helps. Any advice for someone who just recently joined the IT workforce in Europe and is trying to navigate this market with his first earnings? Well, you're buying at a premium. So these are some of the phrases and some of the methodologies we've discussed over the years. This obviously it's a laundry list. So the most important thing is to assess where the hell you are in these markets right now. And Bitcoin's rallied significantly off the lows. It's up 150%. So everything's at a premium. So for an example, if Japan Fed doesn't raise interest rates and something breaks and collateral volatility spikes, you see move at 150, 200, and shit's hitting the fan, or regional banking has some sort of cascade effect and the BTFP takes a week to backstop instead of a weekend, then you could easily see a regression to the mean. Now you'll want to zoom out, so a regression to the mean for Bitcoin is like 27,000, and that'd be a hell of a haircut. So it's imperative to understand, are you buying at a premium or a discount? And right now, everything is at a premium. So if there's any mean regression, there's going to be a significant haircut on assets. Now, this is like if you're holding or wanting to own spot assets, which I would define as belonging to the cash position that you treat as an FX asset. You cycle back and forth between Bitcoin, Ethereum, and dollar. And the crypto space, it's stable coins that are the dollar liabilities. Then these are important things to consider. Hey, look at that. It's just up for the last 3 months, period. It's just up, up, and up. In the last 3 months, Bitcoin's from $26,000 to 43. This is not peak opportunity. There are no discounts in these markets right now. And it is very hard to acquire assets at a premium saying, all right, it's up 10x. I mean, literally buying someone else's 10x on the money. And I have a problem buying someone else's 3, 4, 5x. I bought one asset in the end of this year. At the beginning of the year, we took the convex position. And it turns out, in hindsight, that was pretty much bottom. It was bottom other than Olympus Dow exiting their position. So in hindsight, I'm very satisfied with that acquisition. And then the only thing of late was concentrator. But here's a great example. Looking at concentrator price, I wouldn't buy at these prices. How could I buy 200% or 250% off my position? I guess dollar cost average, but there's plenty of reason to expect such a relatively low liquidity asset to mean regress further. I guess it could present further opportunity, and that's probably the way I would inspect it if I saw prices. I mean, literally, you know what makes sense to me? Inverse head and shoulders, breakout to the upside, retest. I would love to see a retest to 0.236, which would be like 85 cents, and I'm like, yeah, I was able to acquire at this price. All of these folks that had assets, it's not like this isn't a tradable asset. So it's not like folks bought the breakout at $1.15 and then sold at $2.40. There's no liquidity for that. You got slippage and losses everywhere. So literally, this is folks. If it gets down to that level at an 85, that's folks that had the asset, that have been bag holding for the whole bear market, and they're like, holy shit, it just tripled. I'm able to get out of my position. And they're probably sitting on big losses, because this thing was obviously much higher in the past. 2, 3, 4. Well, not 4, but they could easily be sitting on losses from up here. Okay, it did get up to almost 4. And they're afraid that it's coming down, that they're going to miss out on the capacity to exit the position which they've held for all these years. And that presents an opportunity, and that may be the only condition in which I'd be tempted to entertain a larger position size, a significant retrace. As the value for me is, it's not the price. The value is the control over SDCRV. And eventually that, in theory, should be expressed in price, of which this is a completely mispriced asset. I mean, this is like an egregiously mispriced asset. But why am I talking the way I'm talking about acquisition versus the potential for the asset, because you have to understand vested interest. You have to understand the peers and the behavior of the peers. The peers, other owners of the asset, aren't necessarily looking at it like I do. And that's a risk. Vested interest, people that already own it, peers are a risk, which present potential opportunity, or if there's alignment and enough people do see it the way I do, then it just appreciates from here, and that's fine too. So you miss out on a larger position size, or you're able to acquire a larger position size because most people are continuing to misprice the asset. I would not buy at this price, albeit there's great reason for it to continue in a favorable price action direction. Look, it's literally a retrace to the 0.618 golden fib, and that'd be nice to see. And I would be very content with the position size I was able to acquire at 70 something cents. So that's hopefully offers some insight into the way my mind works with regard to low liquidity, high volatility assets. It's good to inspect the holders chart. I mean, who's going to sell 20,000? I mean, it's only the folks that actually have 20,000. Most folks have under 10,000. There's only 25 people that have over 10,000, other than depositors, but most are locked, other than Treasury, and I'm sure they're not selling because it's just they control all of that voting power. I mean, there's not an individual actor that has that has over 100,000 liquid, and there's 5 million assets total. It's fully diluted, max already emitted, so it's very interesting. Anywho, what else do I got up here? Joe looks good. Heck of a chart, but I don't need to diversify onto Avalanche. Coincidentally, I do have my Stargate position on Avalanche versus mainnet, or that's the way it worked out. Go figure. Frax over $9. Wild to see. Prisma's been interesting. It is completely impossible. It is illiquid. It is completely illiquid to exit LP incentives without losing 50% of your money. First off, if you get your VE boost, your VE Prisma liquid, it's a 50% haircut from the protocol. And second, if you exit vis-a-vis LSD, CVX Prisma is literally trading at 50 cents on the dollar, half Prisma price. It is prisoner's dilemma to the extreme. This is a fascinating experiment because it's relatively high emissions in these first couple of weeks, and it is completely impossible to exit. This is an experiment, and it's fascinating to watch, and it's going to be interesting to see how it plays out. I would not be tempted to acquire anything else. In fact, the LP position is going to be liquidated for cash, but might as well take advantage of the accumulation of incentives, because it literally, the incentive claim is locked. You cannot claim this and liquidate it if you wanted to. So I would argue strongly that it's a tax-friendly LP incentive. Go figure. I think they were very smart in the way they structured this, and I think it was well thought through, possibly from that angle, which is quite interesting. I hope that helps, Snoke. It's not easy, and the most important thing is to find comfort. To engage with these markets successfully, you need to be comfortable. These are not equity markets. They're extremely volatile. But a lot of these principles that I apply are totally applicable to equity markets as well. The problem is equity markets suck. And that doesn't matter whether you're from the US or Europe or wherever. Equity markets suck. They're stupid. They're literally it's like 1.0. That's why they call it DeFi Finance 2.0. I don't know, whatever the hell you want to call it. It's just analog versus digital. You're literally going through all these counterparties and transferring capital from a bank to a brokerage. And then if you dare to understand the way a brokerage works with regard to its counterparties, it's disgusting. You know why? Because each counterparty is a company with people and employees and human resources and operating expenses. It's freaking gross when you're literally comparing that to a company that is a piece of software that has no people and the cash is literally just paid. It is a pure dividend. It is a pristine enterprise. Traditional equities are just stupid in comparison. Hope that helps. Interested in seeing where CTR starts getting noticed? Yeah, yeah, I as well, and that's all I could say about it. I'm happy I saw it when I did, and I was, you know, imagine me the way I granularly inspect these markets and I could see opportunities. It was the only one that stood out to me amongst everything. You know, plenty of reasons to buy trend breakouts. You know, looking for the directionality change. Literally look at the stablecoin charts, and liquidity in the space is going up. So you can pretty much buy anything, and it appreciates. So you can buy breakouts, and that's just not me. I don't want the technical trade. I'm an investor, and I wanted to buy. I was only willing to buy like, oh yeah, that makes sense. And the thing that makes most sense for me is a small position, position that has great potential. And I needed to be able to acquire enough position size. And that what I was able to do with a relatively small amount of liquidity, and it was literally the only thing that made sense for me in the market conditions the way I saw them. So go figure. Um, High risk, plenty of risk, but if you're buying bottom, it was 70 something cents, and I saw the inverse head and shoulders, and I was like, boom, pushed it through resistance. I think I took a little bit more in this range just as it was breaking out from the inverse head and shoulders, and that was it. I mean, it's literally bottom. So it was just from a technical perspective, it was like, all right, it's 100% off bottom. There is confluence suggesting directionality reversal. Now, the thing is, you might not get opportunities, or at least the best of the best opportunities you want for years. So, look, we literally waited 2+ years, 2022, and it's the end of 2023, for opportunities. And myself, it was 4 opportunities over the last 2 years. So you have to be so protective of your capital because these markets will take it from you. Find the best of the best. And I understand that doesn't translate to that being easy. I don't have the answers, unfortunately. All I have is this conversation, and hopefully folks find their path. And I hope to help as best I can. If you choose between convex and frex, which would you feel more comfortable holding? I hold both. Just want your opinion. I hold both as well. I have a favorable opinion of both. Convex is quite the productive asset. I'm very happy it's part of my portfolio. It finances a fair amount of income on the year, and that's just personal experience. And Frax, I think, will be extremely productive. Now, bear in mind, for the last 2+ years, it's been in the speculative productive category. But we hear very clear statements that the capacity for it to be productive is large. And with Frax Chain and all the aspects of its protocol in mind, I'm looking forward to it actually becoming productive rather than it speculatively being productive. I would very much appreciate the added income. I would love to see it at 10, 15, 20% return on fair market value at any given time. That'd be nice to see. Asarco, hey, hey. Oh, but by the way, athletic concept, it's two different systems. Two very different systems. So it's not as apples to oranges. Historically we said, overexposure to a narrative. I don't know. You want to be diversified, but Frax controls convex, dominant player in convex. What does that mean? Do you need exposure to Frax if you have exposure to convex? I don't know. In the end, it's hindsight. You'll only be able to assess things like that from hindsight. Hope that helps. Asarco, pleasure. I wish there was a liquid wrapper for CTR rather than just holding with no yield or lock. They just came out in the bear market, these assets. So KMET's interesting what they've done. I'm looking forward to it. I mean, FXN, if that's a foreshadow of what the overall Aladdin DAO could come up with as a community and as a team of software devs, I have now my exposure. I would love 100x on the money. And that's not me making 100 mil, but that's me doing something meaningful. Have reasonable expectations. Go figure, look, 100x on the money is reasonable. But it's a relatively small position. So 100x on the money would change the composition of the portfolio. That's not, 100 millionaire. So you have to have reasonable expectations. All these folks buying stupid Dogecoin and Shiba Inu and all that shit over the last years trying to make $100 million. The expectations are so unreasonable. Gotta have reasonable expectations. Oh my. James, hero doing things. Finally, the project coming to fruition. So that's my opinion of Solana. I need not have exposure to Sol. I have exposure to its federation. Now, it was speculative, and that's clear. And when I acquired it, Sol was just going down, 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 and down, and everyone was like, Sol's not going to make it. This was literally FTX collapse. And but it was a federation, and protocols were building on it, and that's how I identified the potential for it. Look how many protocols in Solana are using it, thus dependent on it, thus contribute to it. So and it's all just a positive feedback loop of ESHXRO, just getting recycled over and over, and it's very interesting. So, I mean, it's literally at 100 mil market cap, so I don't know how far it could go, but probably what I'm looking for is just a 10x and 20% APR, and then that would put it at a bill market cap, and I guess that's reasonable. That would be a hell of an expression, validation of it and Solana in general, but that's where I see Solana as an enterprise chain, and that's exactly what Hero offers, enterprise tooling. Very interesting. Hope that helps. Not sure Etherscan accounts for those peers that have claimable CTR. Good point. Good point. So, okay, so that's potential depreciative pressure. So, all of that is to be considered. Angelo, how would Frax be productive? Do you know what Frax earn cash on? Yeah, RWAs. They have the corporation that they created to buy T-bills, so they're getting 5% of the money on whatever's in there, and whenever their bonds come out. So the potential for Frax revenue is extraordinary, especially with regard to Frax chain. So I look forward to having better clarity, and that will only come when revenues start, and then you're able to see directionality of revenues and the potential for them, but the potential for revenue sources is clear. What the revenue from those sources will be, you will only see when they start to produce cash flow. Speculative cash flow category, but of all the protocols in the crypto space, I mean, the potential is there. It's written everywhere. Now, the problem is For late participants, folks getting into the crypto markets now compared to 2022, it's late. It's up 100, almost 100%. I mean, bottom was, yeah, it's up over 100%. Well, the all-time low was literally back in, oh yeah, it's up over 100% from all-time low. 23 was a hell of a pop. Did it really get to $14? Jesus. $4, it's at $9. You're buying at a freaking premium. And I don't care how great a damn asset is anymore. I am not buying at a premium. I understand the way these markets work. I understand mean regression. I'm not buying at a damn premium, and that means going forward, probably have the portfolio constructed the way it's going to be, passing through 2024 and into 2025 and into the end of the next cycle. And then it's just cash management. And it's just liquidating your FX pairs into stables, and you have the biggest bag that you can as move blows up and the carry trade in Japan does some wicked shit, and crazy shit goes down. And that's the way it's going to be. It's going to be an interesting 24 and 25 as we start top hunting. We have bottom. Bottom is established. The complexity is there's plenty of things that could be very disruptive to this directionality. It's not going to disrupt the overall macro directionality of these crypto markets, but you can see significant retraces to the mean. Significant mean retraces. You can see literally 50% retraces in a lot of shit, and that doesn't disrupt directionality. It gets papered over, and then some sort of liquidity inflow occurs. And there you go. The direction continues. No discounts in these markets right now, friends and family. Hope that helps. 34 people made it to the end of the stream. 11 likes. Smack that thumbs up button. Welcome back to favorable liquidity conditions. These crypto markets are sure to be very interesting over the next 2 years probably at this point. We'll keep an eye on it. We'll keep doing these streams. We'll keep you posted on what the hell is going on in these markets, and buy at a discount, not at a premium, and we'll make sure those expectations are reasonable. I thank you all for joining me and making it to the end. Thursday, December 7th at 1:09 p.m. I wish you all a wonderful day. In the description is a link to the most rational community in the entire crypto space. I appreciate everyone that survived the bear market together as a crew. That was awesome. I'll catch you guys next week. Have a good one. Peace.